Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, I'll ask you to hit thumbs up and subscribe. Questions, comments, put those below. Wanted to open up this week's conversation with basically a background, a 101 on central banking. I think these guys are probably one of the most easy and predictable group of individuals in terms of figuring out what they're going to do. Which I think there's a lot of misconceptions out there about maybe what is morally the right thing to do and what central banks will do. But I want to kind of start off this conversation with a quick clip from Tiff Macklem, who is the new whipping boy at the Bank of Canada, with Stephen Polo's obviously coming to the end of his term. So Tiff Macklem gave his first discussion or interview to the Finance Committee. So let's clip to some interesting comments from Tiff right here.
How much of an interest rate hike could the average Canadian household sustain before they would be unable to pay their mortgages or other credit market debt that they hold?
I want to stress that our focus is on supporting the recovery. The Bank of Canada has lowered interest rates to the effective lower bound of 25 basis points. We have embarked on a strategy of large-scale asset purchases, and that has a dual purpose, partly to restore, one purpose is to restore good functioning in our debt markets. The other purpose is to lower interest rates out the yield curve.
Sorry,
and we're very,
so go ahead.
for now and for the foreseeable future, we're focused on providing the monetary stimulus and delivering low interest rates to support the recovery. And that is lowering the debt service costs that households face, and companies and governments.
How many households would become insolvent with a 2 percentage point increase in interest rates?
Are extremely hypothetical. We have no intention of raising interest rates in the current circumstance.
Of course not. That's why I'm not asking about the current circumstance. I'm asking about the medium-term circumstance, sir. You've admitted that if inflation rises unexpectedly, that you would raise interest rates. Those were your words. You said that. And we need to, as Canadian parliamentarians, to know what that would do to households. How many would become insolvent if you had a 2% increase in interest rates?
The biggest risk to Canadians coming insolvent is not having a job.
Right.
The biggest risk to Canadians not being able to repay their mortgage is not having a job.
So you have to watch that video and just really kind of laugh, because I mean the question is completely relevant. I mean it's a very rational question to ask. Well, what if interest rates increase? What then? And obviously Tiff, this guy has no idea how to respond. I mean the poor guy's first interview here, thrown under the bus. The reality is, the short answer is you can't raise interest rates. You cannot raise interest rates. Again, this is the thing that I've talked about in the past. This is the debt trap. There's a lot of financial literature on this, but essentially, it's not just over leveraged Canadian households. People have this mentality, this storm the castle mentality that we have a household debt bubble in Canada. Everyone's over leveraged. This is just kind of a crazy societal thing where everybody thinks it's okay to take on enormous amounts of debt. We just need to raise interest rates and teach everyone a lesson. And I get it. I understand that, but you have to replay this in your head and think, okay, if you were to do that, what else? Corporations in Canada are levered to the hilt. The Canadian government, the public, is levered to the hilt. Everybody is in this debt Ponzi scheme, which ultimately comes back down to money credit creation. So you cannot normalize interest rates. And so people say, well, what happens when inflation gets hot and inflation runs away from the central banks? What then? What the central banks okay, what the central banks are going to do, it's already being talked about, the Fed's already come out and said it, it's already happening in Japan. Again, it's called yield curve control. It's basically you put a cap on how much bond yields can rise. So basically the central bank comes out and says, listen, we will buy any and every single bond to keep a mandated floor on how much interest rates can increase. The second thing being, again, if central banks were hypothetically to raise interest rates to squash any sort of inflation that comes, you have to understand there's a difference between, you have to understand real interest rates. So, for example, inflation might be, let's say they raise interest rates 2%. Because inflation starts to get out of control. In order for them to do that, they'd probably want inflation at like 4%. So basically what it means is inflation is running significantly hotter than where their overnight interest rate is. So basically what it means is you have a real negative interest rate. It's a real negative interest rate, which basically allows the inflation to essentially erode the value of the debt. So they suppress rates while allowing inflation to run hot, which is, again, essentially devalues the overall cost or the overall burden of that debt. And it's been done, pick up any financial textbook, go back and read. Again, I've encouraged you to read the book Manias, Panics and Crashes, talks about this ad nauseum. This is always the path that central banks have been going down the path. This has always been the path for decades, centuries. So forget this whole notion of an interest rate normalization that the world, again, can't handle it. And unfortunately, that's where we are today. And unfortunately, central banks have basically come out and maybe not explicitly, but are explicitly telling you that they have an incredible mandate to devalue and destroy the worth of the currency. Okay, when Fed Chairman Jay Powell goes on 60 Minutes and tells the entire nation that they have an unlimited money printer, that should basically tell you all that you need to know. And so I'm kind of using this more and more as my framework, and I've done videos in the past that says, we've talked about the infallible central bank, and a lot of financial markets putting a strong weighting on that. And I think it's important to understand that, yes, I don't believe that central banks are infallible. I do believe that you have downturns, as we saw in March. I do believe that we're going to continue to see a lot of volatility over the next 18 months as we get through this economic calamity. Let's call it what it is. It's an economic calamity. You're going to have extreme amounts of volatility. So whether you're talking about stock prices or you're talking about real estate prices, you're going to see some volatility. You're going to see some drawdowns. I'm just looking at this now from, again, if you're going to say, let's say hypothetically make a real estate purchase, you have to look at this in the long window, long frame. So let's just say I think there's a significant probability that you'll see a decline in home prices over the next 12 months. Again, whether that's 5% or 15%, I think you're going to see some volatility. But again, if their mandate is to have an unlimited money printer and flood markets with credit or currency, where does that put the value of assets? Like, what would you do? So I gave this hypothetical to an individual who is, for example, very bearish on the housing market, extremely bearish. And I said, yeah, I understand. Like, I think your concerns are extremely rational, and we have very unaffordable housing. We have really low rates with little room to sort of stimulate on that front. You kind of have this household debt bubble that's been kind of pushed forever. And I totally understand. I totally agree. But I was thinking, I was like, if you had to put your money in one spot for the next, let's say, 10 to 15 years, like, where are you putting it then? Like, if it's not real estate, I'm not saying real estate is like not where you have to be, but if it's not real estate, like, where is it? It's got to go somewhere. You can't tell me that the central banks are going to print an unlimited amount of money, or they're just going to do unlimited intervention, just buy every single corporate junk bond there is, and basically erode any sort of price discovery that you're going to sit there and hold cash. for the long run. So what are you doing with it? And the problem was the guy didn't have an answer. I'm not telling you kind of thing. I was like, why? Like just say like where are you putting it? You got to put it somewhere. So what is it? My view is real assets. That's my personal view. So I do think real estate in some context, yes. I do think like I'm a bit of a gold bug because I do believe in I'm a hard money kind of guy. I do believe in that. I think Bitcoin is a bit of a longer term upside, but it could potentially go to zero. But again, more of like a hard money sort of thing. But again, you got to put it somewhere, man. So this notion that like everyone wants to shit on like real estate, for example, I get it. Like, but like, hey man, like you got to put it somewhere. So that's kind of my view of things now. Is I'm just kind of looking at it from this central bank aspect. I still think real assets over the next 10 to 15 years are going to perform extremely well because again, the value of currencies are blatantly in front of you on national television being debauched. So that's kind of my view on things. I think that unfortunately these policies that central banks are enacting, and they're not new policies. These are not new policies. They've been done hundreds of times. These were done in the early 1900s. Yes, QE was around back then. That these policies ultimately just create more of a wealth inequality, and I really do fear of what society could look like on the other side when you have, again, these policies are specifically designed. The mechanism is designed to essentially inflate asset prices. Okay, that could be stocks, that could be real estate, that could be the price of a bond. Inflate the value of assets, and who owns the assets? Typically speaking, it's the top 20-30% of individuals. Even say even the top 50 and the lower side of that will own assets, so they will benefit from that. But then you have basically a portion of society which is essentially kind of your bottom 40-50%, which really doesn't own much assets at all, and those are the ones that are unfortunately impacted the most. And so I kind of fear what that social friction looks like over the years. So I would encourage you during this video this week is just to kind of think from the bigger picture of what central banks are doing. I mean, just to close, I'm going to close on this. The Reserve Bank of Australia, the RBA, a report was leaked where they're actually promoting to regulators to put a pause on the real estate market. They wanted to basically tell housing regulators, policymakers, people that are putting out home price indexes, for example, to stop reporting on the property market in Australia for fears over a potential price crash in the Australian housing market. So these guys basically want to suppress any sort of information or price discovery getting out in the market. That's who you're against. That's who you're fighting against. Is these global central banks that have the power and the ability to man and the printing presses to distort information, to distort price discovery. Again, when you basically nationalize the bond market, you are removing a natural pricing mechanism. When you bring interest rates to zero, you are destroying price valuation mechanisms. So that's why you have housing completely distorted from incomes. That's why you have, for example, the stock market completely distorted from what's happening in the real economy today. So I will leave you with that. Things to think about, thoughts, comments, post them below.